So here we go, the UK stocks I'm buying, March 2025 edition. This is the most popular video series that I do on the YouTube channel, which is all the stocks that I've been buying and selling from the 1st of February to the 1st of March. So any moves that I've made in my UK stock portfolio are on this video here. There's nothing hidden. Some other YouTubers like to only show you when things have worked out, or if something doesn't work out, they quietly sell it in the background. Any moves that I make are always on this video, so you can go back to previous videos or previous year's videos and you can see those stocks I've been talking about, and you'll be able to see if they've worked out or if they haven't worked out. So it's quite good for the transparency. Hope you enjoy the video as always, guys. Hit the like button. If you could subscribe, we're near 18,000 subscribers, and if you do get me there, I'll do a live Q&A session for you guys on a Sunday when we do get there, which could be next week at the rate that we're going at, which would be amazing. But apart from that, let's get started on today's video. Now, just a quick shout out, if you do want to support the YouTube channel and also get 2 exclusive videos a week, join the Patreon, links in the description, £6 a month, and like I said, you get 2 exclusive videos a week on there, and as well as that, you get a Discord with 600 members on to talk about stocks, including me. Fantastic community out there, and like I said, £6 a month, or if you pay yearly, I think it works out as like £60, which isn't that bad at all. So for example, this weekend we did the stock request. This is where members of the Discord vote for me to take a look at the stock, and we have a look at Transmedic on there, which was one of the 2 exclusive videos. And as well as that, if you do want to start investing, join Trading 212, the link in the description, and get a free fractional share worth up to £100. That's personally the investing platform that I invest with, and it's fantastic. But let's get on to the first stock that I have been buying, which is JD Sports. I have been buying very aggressive into JD Sports right now. A stock that I've owned for a while. I've owned this stock for nearly 5 years. Started buying during the COVID dip, had a fantastic run up. We were up over 100% on this position. Had a bit of a pullback during 2022 as we had the whole Ukraine-Russia situation and the inflationary environment, a lot of things going on during that time frame. Liz Truss period of time, and then we had a bit of a rebound. Stock went massively up again, and then really there's been a couple of bounces, but the stock has been on a downtrend really now since kind of 2023, and it has fallen another 56%. Now, just to put it into context, obviously not the best way to value a stock, but it gives you a bit of an idea about how aggressively it has dropped. This stock is now valued lower than where it was during the Liz Truss period of time, which obviously there was a lot of fear out there, the inflationary environment. It's now 20% lower since that time frame, and from the COVID lows, which it was exactly nearly 5 years ago now, which is absolutely scary to think it's been 5 years. It's just about to move off the 5-year chart on Google, funny enough. And since that time frame, yeah, the stock is about, on the worst day of COVID, or the fear of COVID, it's about the same levels as then. And you think about that time frame, and do you remember the panic of like, okay, we're actually going into lockdown, every single shop is going to be shut, how long is this pandemic going to last for? Is it going to be lasting years? How many people are going to die from this pandemic? You mean that was a big fear time, and yet the stock price is now the same as that period of time, which kind of shows you. And just, I'm jumping a little bit ahead here, but I just want to show you how far as a business JD Sports has come from that time frame, which if we look at the start of 2020, the company was doing 6 billion of revenue. The company is now about to do 10 billion of revenue. You look at the profitability point of view, the company was doing 246 million in profit. The company is now doing 342 million in profit, and that's also including a cost from an acquisition. If it wasn't for that cost from the acquisition, the profit would be even higher than that. That is just so impressive. And as well as that, JD Sports has actually been historically one of the best performers on the UK markets. If you look here over the last few years, if we zoom out, you can just see how much of a good performer it has been, and that's including the big massive drop that it's actually been on recently as well. So yeah, it's been a very good performer. Now let's get stuck into the business slightly. So JD Sports in the UK, I'm sure you are very much aware of JD Sports. You go down the high street, I'm sure you see JD Sports in the UK. We are very much aware of what JD Sports is, and people sometimes look at that as just a UK business. As a UK business, yeah, it's a good brand. It's always very busy. You go to the stores, they're always very busy, and it is a popular place to go to for fashion at the moment. The thing is that we're kind of maxed out in the UK. There's certainly no more growth pretty much left in the UK, but what it is coming is it's coming a global business now. So it's had its success in the UK, and now it's taking it to Europe, it's taking it to the likes of Asia, the likes of North America, And that's where the success for JD Sports is going forward. I think a few people get mixed up by that. I think they just look at the UK business and go, nah, that's not going anywhere. But you got to realise it's about to copy and paste this in all these other areas. Well, it already has done. It's already had some good success from it. But it's got so much growth for it still to be doing that. So if you look at the UK, it's actually now only 30% of the revenue. And if you look at the likes of North America, that's actually the biggest part of the business now, and that has a lot more potential to grow. If you compare that on a revenue point of view, they are easily going to be able to get more revenue from the North America business because of the size of the US. The Asia part of the business has potential to grow quite well as well going forward, only 4%, and Europe as well makes up 31%. As well as that, it's not just a store business. They do have online presence, as you can see here, by 21%. And if you look at the UK business, basically the same store count is to stay level in the UK. So they're just going to basically look at stores that are not doing that well and close them down and then try find a more efficient store anywhere. They're just kind of managing the stores in the UK right now. With the EU, the target is to get those stores up. So they currently have just a bit more than what they currently do in the UK right now. But they think they can nearly double the EU amount of stores. You look at the US and Canada business at the moment, there's potential to double, triple that business going forward, and the rest of the world at the moment, that's still in the early days at 92 stores. That has the potential to 4-5x the amount of stores going forward, and the aim is to open up around 200 a year. So you can see here, this is what I think a few people get wrong with the UK business, is that yeah, that's near the max potential now, but the fact is they're going to now expand this into the likes of Europe, Canada, US, rest of the world, Asia. There's so much growth for them to go for going forward. And even what has been a pretty poor year for JD's kind of standards, it's still not been a bad year for them. You look at the moment, they've gone from around about 10 billion in revenue, and that has grown up to from 10.5 billion in revenue to 11.3, just short of 11.4 billion in revenue. Even in 2026, with forecast growth at very, very good rates, a lot of businesses would wish they could grow at these rates that JD are currently doing. And you can see here, there's been a little bit of a profit drop off because of the acquisition, but that profit is going to go back up to 635, 643 million. And I tell you something, guys, on a 4 billion market cap, that is a lot of profit for a company. And right now, that will put it down to a 6 times earnings business. So at the moment, if we look at JD, you're also getting a little bit of a dividend, let's not forget, but it comes up on most sites as 12 times earnings, which is already pretty cheap, I'd argue, but it's not a real PE that, because they have a lot of acquisition costs. So realistically, this company is actually around about 6 times earnings, forward earnings right now for this business, which is just way, way too cheap, especially when you look at this company here and you look at their track record of delivering, the revenue growth and profit growth, as you can see here. Fantastic. You look at the balance sheet, absolute amazing balance sheet. They took on a little bit of a debt for an acquisition, but in the latest update, they actually said they paid most of this debt off, so that's not even much of an issue now. They've got a good cash balance, and like we say, they're able to make a lot of profit a year. 600 million a year is a lot of profit to go do acquisitions, dividends, share buybacks with, which is the other great thing. As well as that, one thing you'd like to see when the share price is in the dumps is insiders and coming and buying, and that's exactly what we had. The CEO did come out and did make a very decent sized purchase, buying nearly 100k worth of shares at nearly the 90p range, which is a nice chunky buy, a good amount of his salary, which gives you a little bit more confidence going forward. Another thing, this is coming more of a US business. What do we have coming up in 2026? We do have the FIFA World Cup. Where is the FIFA World Cup going to be hosted? It is going to be launched in US, Canada and Mexico. So what is one of the big times people get excited, go out and buy the likes of football tops, football boots, footballs? It is during this time frame. So this is also going to be a good catalyst, I think, in the summer of 2026. Right now, like I said, 6 times forward earnings. The average this company normally trade at is 23 times earnings, 20 times earnings. So even if we assume that there's some metric compression at 15, 14 times earnings, at 6 times earnings, there's still so much potential for this company to be a lot highly valued than where it is right now. And like I said, the last update, people threw it under the bus. When we look at the 9 weeks they updated during the January period, people were a little bit upset with the performance. I thought it was okay. 3.4% revenue growth, that's okay. Sure, like for like was not as good as what we were hoping for. I'm sure that will bounce back. Obviously, there's been a lot of concerns at the moment in this kind of space that they are currently in. But gross margins still remain very positive. They are not discounting. What we're seeing at the moment is a lot of people in this space are having to discount. And the fact that JD Sports can stand there and going, we're not discounting our products and still put up these financials actually sounds like a good thing to me. And the fact that the profit before tax did get a slight downgrade, we're talking about a 3% downgrade on the profit guidance. Let's not forget, JD Sports is currently 6 times earnings, and what that threw off on the share price point of view was absolutely ridiculous. The fact that this company's lost nearly half its value since September for a 3% profit warning is just absolutely staggering to me, and a really good opportunity for a stock that has just been way sold off. And you start looking at the competition, look at Nike. Nike has had a poor period of time, and Nike coming back with good products will only be good for someone like a JD Sports. And during this time period where it's been a little bit weak for these kind of companies, I mean, look at Nike. Nike's down 7.8% year over year on their sales. You look at Foot Locker, down 5.5%, and this company is trading at 12 times forward earnings. So this company here is a bit similar to JD Sports. The growth is negative. They also have profit declining rapidly as well, but yet this is even valued more than JD Sports. It doesn't make sense to me. I think JD Sports is megally undervalued right now, and I am buying up JD Sports. Moving up to number two. Number two is B&M. So another retailer that's been sunk down at the moment. I think there's a lot of fear around the consumer environment, the current government at the moment, the increases of the tax, the NI contributions, the living wage. And I think this has just made so much opportunity in retail stocks or high street stocks in the UK where, you know what, it could be a tough 12 months for them as they absorb these costs. But in the future, we'll see the bounce back, we'll see the revenue growth come back, we'll see the profit growth come back in these businesses. And I think that these at the moment are priced with a lot of fear in. And I think some of these will look very good buys in 4 or 5 years' time. B&M, exactly the same as what we just talked about with JD Sports. It has been crushed. Since the start of 2024, the stock is down over half its market cap, which is absolutely bonkers. You're looking at the levels, like I said, it's not a good way to value B&M, but it gives you an idea of how low this has dropped. The same time with that 2022 situation, with that inflationary pressures, the Russia-Ukraine situation, the Liz Truss period of time, the stock is now 15% lower since that time frame. And if you actually go back to the COVID time, it is actually slightly lower, 1%, 2%, is slightly lower than the COVID time, which is just bonkers to me because as a high street retailer during that time frame, you've got that panic of like, oh, the lockdown's happening, how long is it going to last for? And the fact that these stocks are going lower than them levels is just, it doesn't make sense to me. That shows you how much fear is in there right now, in my opinion, that is happening. Same again with B&M. When we look at the company and the progress it's made since those COVID days as well, the company has done very well. And the revenue has gone from 3.8 billion up to 5.5 billion. The company's gone from 203 million in profit up to 326 million in profit as well, which is very, very good growth from B&M. For a company that is not supposed to be that much of a growth company, that's pretty good levels of growth in my opinion. Now B&M, I'm sure you've seen them around the UK. They are opening a lot of stores up at the moment. I like B&M, there's definitely good bargains to have there, and they'll continue opening up some shops in the UK, and also they have the potential of the growth into France at the moment. Now they came out with a recent update, the CEO did say that he is going to leave. I think he was pushed. I think they went, okay, time to get a new CEO in, and also they did a bit of a profit downgrade. The profit downgrade wasn't a huge amount. I think a bit like JD Sports, it was only like 3-4% downgrade in the profit, but yet the stock has only continued to fall since that time frame, and I think that's just been overdone. Now looking at the CEO change, I actually think this is a positive for B&M. Alex Russo came in 2022, and he was previously the CFO. Historically, CFOs don't normally make good CEOs, and the fact that he'd been in for 2 years, and he's kind of had his bit of period of time to kind of say, okay, what can you do with the business? And the share price hasn't done that well. And as well as that, when I listened to him, he was also pretty overconfident, I would say, in my opinion, on the conference call. And the fact that he was so confident, and numbers have maybe obviously come a little bit slightly under the guidance and the share price performance, I think people have looked at him and gone, okay, you've been here for 2 years, you're a little bit behind where you should be. let's go for a change. And I'm happy with that because, like I said, a bit too overconfident. You got to hit your targets. And when you look at the share price, and CFOs not only making good CEOs, I think it was a good idea to probably get the change in the CEO. But looking at that, new CEO comes in. It's very easy for this company to do well from where it is right now, in my opinion. Revenue growth is still growing strong in the business, as you can see. Yeah, there's a little bit of a dip in the profit at the moment, but obviously with the big changes in the tax, the NI situation, they are having to manage a lot of costs at the moment. And I think after they get out past the next year and we go into 2026, we'll start seeing the profit kind of come back if there's not any more, if there's not any more tax hikes from the UK government. We never know, but I think that the fear that's priced in now has priced a lot of that in. Like I said, 7 times earnings for this business. As well as that, you're picking up a pretty chunky dividend. The dividend is around about 5.6%. They also sometimes pay a special dividend. The special dividend puts it up to, I think, 11-12% yield if they do pay that dividend going forward. And I think the footprint for this company to do really well is quite easy, really. They've currently got 764 B&M stores in the UK. The target is to open up another 1,200. So if they do that, nearly doubling up all the stores, very easy maths, double up in those stores, or lazy maths you could say, is double the revenue, double the profit. The other thing that they have is the B&M France. This is growing even faster than the UK stores, and this could potentially be a good growth driver for them. They've got 129 stores. If they get somewhere to where they're currently at in the UK side of it, obviously, once again, you could see a doubling up of the revenue and profit from the growth in France. So very easy for the new CEO to come in, just get nice like-for-like sales in the current stores they have in the UK, add some more stores and carry on growing that France business as well. B&M as well, people love it. People actually like going to B&M. And if you actually go on YouTube, B&M actually don't need to do that much advertising. You go on YouTube, you won't see videos like this for Tesco's or Marks and Spencer's. People actually vlog going to B&M. And you can see here like a spring haul March 2025 and 10k views, as you can see here. B&M spring 2025, another 20k views here. One about the garden products that they do, another one here, 17k views. What's new in B&M spring collection, and another 2k views. There's just so much free advertisement that goes on with B&M, which is obviously great for them. And should continue to grow. Pretty high profit margins, as you can see, for a company like this. Retailer that gets 6-7% profit margins is good. Balance sheet could maybe be a little bit better. They do have a little bit of debt on there, but they seem to be managing it okay. They've got an okay cash balance, and there has been a couple of insider buys coming on. It would be good to see when they do get the new CEO in, which they do say they're quite far into. They come in and buy some shares as well, but there's some insider buying going on, which is good. And normally, look at the company, it normally trades at like 19-20 times earnings. I don't think it will go to that sort of level. I think it'd probably be like 13-14 times earnings for B&M. But like I said, when we look at it on a forward P right now, it's going to be on a forward P around about 7 times forward earnings. So if I do assume that kind of multiple, this alone, not assuming any growth, would have a double up in share price just from metric expansion, which is obviously, really good. So I really like B&M. Moving on to stock number 3, which is Gaming Realms. So Gaming Realms is a stock that actually did quite well during 2020, 2021. Stock went ballistic, as actually when you look at the share price. But for the last 3-4 years, the share price has done nothing. It's flatlined. In fact, it's slightly down since that time frame. If you did buy during 2022, you are up slightly on the position. But what I'm seeing at the moment is the stagnation of the share price since 2021 is a bit too much, because even though the share price has stayed flat, all the financials for this stock have just gone up and up and up. And in fact, if I just jump ahead again on Gaming Realms to show you guys, you'll be able to see here from look at the revenue growth. Look at the revenue growth here. Look at the profit growth. It's just gone up and up and up and up. Very nice revenue and profit growth from the business, as you can see here. So the stagnation of the share price now, in my opinion, means this stock is a little bit too cheap at 16 times earnings. And if you look at the revenue growth, 17% revenue growth, net income growth of 31%. Now, if you don't know what they do these Slingo games, and they are these iGaming games. There's got a lot of versions. I'm on Sky Bingo right now, and they even do ones like Deal or No Deal, and they're really on the iGaming growth. They've been signing a lot of partnerships. These games have been very successful, and as well as that, they have the growth just in markets like the UK, for example, Europe. But the big one is the iGaming growth in the US. So if you're not aware, Basically, iGaming, online gaming like Slingo, wasn't allowed in the US until a few years ago. Absolutely bonkers to us guys in the UK that is the case, but it's true. And we do have a few states that are now starting to allow iGaming, and this is going to be a big growth driver for them as they partner up and offer their Slingo games with the likes of Sky Bet, but not Sky Bet in the UK, in the US, but like DraftKings and Flutter, FanDuel. And as they offer these games in the US and more iGaming is allowed, that's going to be a big growth driver for them, just like the likes of DraftKings, Evolution, and there's going to be more and more states added, and that's going to be a big growth driver for them, as well as getting new clients on board for the Slingo games. Potentially, the key drivers, just like Evolution and DraftKings, is new states coming online. If we see the likes of New York come online this year, that's going to be a big growth driver for them. And even without that, the company has been doing amazing. You know, the last trading update, as we kind of started showing at the start of the year, you know, the revenue growth was up 22%, as you can see here. EBITDA was up 30%, and all these metrics have been going up in the business, yet the share price has done absolutely nothing, which is just absolutely bonkers. Balance sheet wise, absolutely cracking balance sheet, no debt on there, healthy cash pile, like you can see here, 10 million, which is about 10% of the market cap, and that cash pile is just growing more and more. They don't have many staff, so they're not going to be impacted with like the NI costs and what have you. Those profit margins are just expanding more and more, which is absolutely great. And we're picking this company up at 10 times forward earnings. You should not be picking a company at 10 times forward earnings that's growing 20% a year, in my opinion. So really, really good value for this one. And the fourth stock and the final stock is Warpaint. So I have been buying some shares in Warpaint, 16 times earnings. You do get a 2.5% dividend yield from this one. Stock has had a bit of a downtrend in the last kind of couple of months, but in January, had a big drop down another 28%. So overall, yeah, the stock is now having a significant drop down 40% at the moment. And I actually think this is a good time to be picking up some shares in Warpaint. Now, if you don't know Warpaint, they sell high quality branded affordable cosmetics. They do have a small team of 140, so not going to be impacted with the big NI cost and minimum wage increases like a lot of other businesses. They outsource it to manufacturing companies in like China, for example, which could put them towards tariff issues, maybe something to be aware of, but nothing too much. Clean balance sheet, big cash generation, and also profitable growing at the moment. They are mostly the UK business, and that's where they have had success, but they are expanding international now, with international growth being very strong, and most of their sales come from this W7 brand, and they do launch them into other stores like Morrison's, Boots, CVS, Five Below, for example. What they do is quite often do like dupes, so you'll be able to see here, like this is their products compared to the more expensive ones, so they do cheaper alternatives to some of the big branded products out there. Their hope is that you buy one of these dupes and then they go, actually this is really good quality, and then you actually go buy some of their other stuff that isn't dupes. So had very good success from that point of view. Like I said, most of the sales do come from the UK, which is about a 1.9 billion industry, but the expansion into the US in particular is obviously a big one for them, because that's around about 19 billion, so 10 times the potential of the UK market, where they've had a lot of success at the moment. Now, in the last trading update, the market did not like the trading update, and that's why they sent the stock lower. I actually thought it was okay. There was a few questions around it. So if we look here, revenue was slightly behind what we were expecting at only 13% growth. We were expecting a little bit more growth from that point of view. There was no clarity on why the growth was a little bit slower, which is why the market sent it down. Probably sent it down a bit too much, in my opinion. What I think has happened is there was a switch between some of the US clients, and maybe it didn't happen in time, but there was no explanation there, and that's probably why the market threw it down a little bit too much. But as you can see here, the strong trading performance has continued into January, with revenue approximately 15% ahead of January 2024 and improved margin. So what they are doing is they are selling things at higher prices. So even though the revenue was a miss slightly and the growth was maybe a little bit of a concern, what they are doing is they're selling at higher margins. So it doesn't impact them that much. And as well as that, we are seeing the sales picking up through January, which is a really positive sign. So I can see why the market sent it down a little bit, because it was the kind of concerns, okay, why did you slow down so much? But at the end of the day, the higher margins are going to cover the drop in the revenue, and as well as that, growth is accelerating. So the fact that the market sent it down 28% on that sort of news, I thought was a little bit too much. So I thought that was a good opportunity to go buy. Now, the other exciting thing is they have also bought a other brand which is Architects. I had to go ask my missus, is there any good products from them? And apparently they have a good fake tanning product. So as war paint probably scales out these products that Architects have into its network and obviously into its suppliers, hopefully it can add new products into there that it can offer into new stores that Architects couldn't do previously, and that has a lot of success for them. It does mean the revenue growth is going to go a little bit higher now because of this acquisition, but if we do look at the company, we're expecting to go from 103 million this in 2024 up to 129 million, and from an EPS point of view, we're currently expected to go down to 13 times forward earnings, which I think for even without the acquisition, if we look at January for example, which was 15% revenue growth, even without the acquisition, 15% revenue growth at 13 times earnings is pretty good value in my opinion, and it's got a very good track record of executing. We've obviously got the margin expansion going on, clean balance sheet, so with that clean balance sheet it's able to go make like the acquisitions of like Architects for example, and with a nice cash balance, so you've got 5 million cash, no debt, and obviously quite a highly profitable business. You know, it's throwing off nearly 17, well by the end of this year, 20 million in profit that it can use for acquisitions, dividends, share buybacks, which is obviously what you want to see. And what I see a lot of US investors talking about on YouTube or Twitter, X, is Elf Beauty, and people saying, oh, this is a makeup brand that you want to be buying. And I look and I think, well, you're all talking about Elf Beauty, which is set to grow at 10% this year, because with Elf Beauty, they're actually in their Q3, so they're about to do their Q4, and that's their financial year 2025 over. So it's a bit confusing because of how they report. But yeah, they're about to enter the financial year 2026, and if we look at their growth at the moment, they're actually only going to grow at 10% overall for the year. 10% is below what Warpaint is doing pre-acquisition, which was 15%, and obviously even lower than what they're going to do now with the acquisition on top. And yet something like this that's growing at 10% is currently valued at 18 forward times earnings. And what we just saw with Warpaint is Warpaint's actually trading at 13 forward times earnings. So Warpaint is significantly undervalued compared to something like a Elf Beauty by nearly 50%, and yet it's outgrowing Elf Beauty by a rapid amount as well. So it just shows you that Warpaint is probably gone a little bit too undervalued now, and especially when you compare it to some other stocks that are out here. And that is the last stock that I bought. Moving on to the stocks I did sell one position. I have already mentioned it on YouTube, but I've got to put it in this video series because I always put them in this video series if I did sell anything here, which was CVS Group. I did sell my position in CVS Group. I didn't buy it too long ago. I only bought it around 2 months ago here, which I called I bought a new turnaround stock. Turnaround stock is something like a stock has been absolutely crushed, which CVS Group had been. You look here in the last few years, absolutely crushed. It's even where it was only a year ago. 1 year ago, the stock has fallen like half. Bought it because I thought, okay, it's gone a little bit too low, too much fear out there, and I think a few quick things are going to come in and I send this stock a lot higher than where it is right now. And yeah, I bought this turnaround stock and thinking that it's just way too low now, and it has had that bounce, as you can see here. The stock did start having the bounce up from when I started buying it in that time period, up around about 30% during that time frame. I decided to walk away from this stock. Not that I kind of don't like it anymore, just that I thought there was better opportunities. There was a lot of fear out here when I was buying it. Even on the comment section of this video, 70% upside in 5 years, not worth it. There's no one wanted to own this stock. They never do. When stocks are down at these lows, no one wants to own these stocks, and that's the best. That's when I like buying them. When nobody wants to own them, when everyone's giving up on them, that's when I like to buy them. And that's what I did. Obviously, I bought it. I saw a lot of upside in it. And obviously, getting 30% in 2 months' time, that's nearly already like a year of profit that I thought I was going to get from it. So very big jump on it. And there's other stocks I like out here for the value that it's at now. It was still relatively cheap, at the end of the day. It was only still a forward P of 10 at the moment. Like, it's not ridiculously overvalued. But as I showed you here, there's just so many other UK stocks that I wanted to go buy. I can go buy Gaming Realms for the same sort of valuation, and that one's growing at 20+% at the moment, where CVS Group is I can't even remember what they're growing at, like 6%, and the profit isn't really moving up on it that much at the moment. So, you know, that was another example that I just think my money was better in, like something like a gaming realms. JD Sports, I think, is still better than something like a CVS Group, because what's that growing at? You know, that's growing at 5%, and that's not right. That net income isn't that sort of levels. Let's go on Stockopedia. You know, Stockopedia, you can see like the profit's still moving up in the right direction. B&M, and I also get a lovely dividend from B&M. Warpaint is maybe slightly higher valuation, but a lot more growth there. I just thought it wasn't as good as like the other 4 stocks that I mentioned on this video. And if my money's better somewhere else, I might as well go and do it. And that's what I decided with CVS Group. So yeah, another nice profit in the stock market on the UK side of it. You know, people say you can't make money during this time period. Well, there you go. There was a nice little quick profit taken there, and move it into stocks that I believe for the longer term a lot more. So I did that with CVS Group and locked in some nice profit. And that's the video for today, guys. Hope you enjoyed it. That was a long one. Thanks for watching. Hit the like button. See you in a bit.